'cause holy shit, what the... A warm welcome to everybody who's tuning in today. Why are we doing this video? Well, I always get asked by my students, Thorsten, yes, we know options is a very cool thing and you can optimize returns and get the most bang of your buck, but how do you develop ideas actually? Well, and the answer, I say, is talk to clever people, talk to smart people, talk to a lot of smart people, and eventually you come up with something, or you get your ideas you had in your mind shot down and can improve what you're actually doing. So one of the smartest guys I know is Nic Themistocles. We'll talk about his history in a second, that you get an idea who he is, what he's doing, and he's one of our ragtag group of, let's call them the expendables, guys who have been in the industry for decades, and not only one or two. In my case, it's now almost 3. In Nic's case, it is almost 4 decades. And he has a lot of letters behind his name, which I don't have. I'll ask him in a second what they actually mean. And very welcome, Nic. Thank you very much for making the time. These are the conversations we usually have privately on a channel when we talk about markets, which happens quite regularly. And to the benefit of our students, I actually thought, yeah, well, let's roll the tape while we're doing it. We haven't had a plan how long we are going to do it. When we get boring, I'll switch it off. And if we get boring, you will switch us off. So give us a chance, have fun with our conversation. And let me introduce Nic. Nic, you've been a trader, a portfolio manager, chief investment officer. Run us a little bit through, how did you get into the industry?
Well, so that is another long thing, but I left university in '82 and I went into accountancy. I worked for a company called Coopers & Lybrand, now PwC, and I got really bored with this thing. And after I qualified, I followed the money, and a friend of mine was a bond trader, and he had a Porsche, and I said to him, well, how'd you get that? And he explained. I still didn't know what he was talking about, but anyway, I applied. And I got a job with E.F. Hutton, and in the '86, I think that was, and E.F. Hutton doesn't exist anymore, but I was in bond trading then from '86, E.F. Hutton, Merrill Lynch, NatWest, Dresdner Bank. And whilst I was with Dresdner, I actually still traded bonds, that was. In the year 2000, there were a lot of these fintechs. So these platforms for trading markets. Everything else was done by phone and voice and whatever. And there was an opportunity to join a fund within Dresdner at the time to actually create and invest in these platforms. We created a number of these things. Some of them were with us today. BrokerTech is probably the biggest platform, part of the founding of that iBox at the time, which is now part of all sorts of market data and so on. So I did that for a while, and that was quite fascinating until I decided after that within Dresdner to move into the loans world. So the loans world was quite fascinating. Leverage finance was the most interesting thing at the time. And my boss, who suggested I work in the fund, in this sort of fintech fund, said, okay, I'm now responsible for leverage finance. You go to leverage finance. I went to leverage finance.
Let me interrupt you there, just for our younger viewers. Leverage finance, there are 2 ways of making money in the markets, right? You either have a big move in your direction, or you have a huge leverage and a small move.
Yeah, so leverage finance is all about financial sponsors, so private equity firms who take the view that, by putting on a bit of leverage, buying some stable companies, they could actually sort of create a very high return on their equity. So I worked in this department for a while until a fund was being set up, as a mezzanine fund. Again, even more high risk in terms of what part of the curve this was. And that suddenly I had a capital markets experience and a loans experience. I joined then LBBW, Landesbank Baden-Württemberg, as the general manager in London, so head of the bank. And what they liked about me was I actually knew both sides of the business, not just the financial markets side, but also the loan side. And that was a very, very typical thing for banks, and for the head of the bank to know both sides. That was quite fascinating. It was also the time of the financial crisis, 2006. You really were at the sharp end. The bank was sort of in the midst of the hurricane, as it were. You had to deal with regulators, you had to restructure business models, you had to restructure balance sheets. And that was absolutely fascinating. We hired some really brilliant people at the time who helped create the the organization that it is today. And thereafter, with that experience and everything that I did for them in London, I became the chief investment officer for the asset management, which is in Stuttgart. And I did that for 3.5 years before I did my own thing.
That's how I usually introduce you when you're guests in my seminars, as Nic, the man who managed over $100 billion equivalent. And Nic very modestly always comes back, nah, it was just something about 80 billion I had assets under management. So that's why I love the conversation with Nic. The insight I get out of this, of somebody who actually, well, your job were on the line with your decisions, right? If you were wrong, you got fired. If you were right, they paid you a Porsche, what you always wanted. Well, you always had one by the time and sold it again by that time. But that is the idea behind it. Talk to people whose decision depend on what they're doing and what they're saying. In my career, you meet so many bright people and they have very, very good ideas, but most of them never push the trigger. Yeah? And that makes a huge difference in your investment allocation if you actually push the button or you don't push the button. In my experience, I'm very, very good in predicting markets when I have no exposure to the markets. The moment I get my own money in, this ratio somehow drops massively. I don't know why, but it's human feelings that come in there. And at this point, obviously, having somebody like Nic on board and to talk about the current situation we have in the market is quite fascinating. Let's make this skip then. What do you think about the situation at the moment? And we don't want to go into detailed numbers. Who I expect next week CPI figure plus 0.02, when the rest of the market expects 0.3 or whatever. But we are, in my opinion, at a very crucial stage at the moment. We've seen the market. We are sitting behind the screens. I sit behind the screen since 95. You just said you started in 86. I didn't have my A levels then by the time I was still in school. So it makes a difference. We've seen a couple of rodeos and we've seen a couple of exaggerations behind the trading screens. Where are we at the moment, Nic? Give me an idea, a rough idea. What's going to happen within the next 6 months?
Well, to be perfectly frank with you, if you were to read Twitter, it's the end of the world as we know it, and it's very easy to get down that alley. And there's always the odd chart on this pointing down or that pointing down. M2's going down, worse for 80 years. Get out of this stuff. And even there are a lot of people who have a very strong investment process who kind of miss the fact that there are some other things going on. And I think the fundamental things that everybody needs to have in the back of their mind is, A, we are in a world of excess debt, and that has its implications. And, at the end of the day, we are also in a world where there's increasing liquidity. And there has to be increased liquidity in the system. Otherwise, the whole thing would fall apart. The debt would never get refinanced. And there are some outstanding people who have gone, on Twitter and on YouTube, who explain how liquidity works and how that is a bigger driver to what asset markets are doing, rather than what's the CPI next week, what's the next Fed move, and things like this. So the much bigger picture, the framework that you have to remember is there is a consequence to this excess debt, and it's important that there is increasing liquidity, because otherwise that debt will never get refinanced. And if that debt doesn't get refinanced, then all hell will break loose. And once you're sort of down that alley, you'd say, well, okay, surely the Fed want to engineer a crash, or they want to engineer a slowdown. They want to try and, reduce inflation. Well, inflation was caused by the Fed, by the central banks. It wasn't caused by a war here or, some supplier constraints over there, per se. It was caused by a flood of money which hit the markets in the year 2020, 2021. And that's where, the whole industry who understood what was going on at the time were effectively saying, oh, we're in a world of reflation. You can buy everything and you can buy anything. And the Fed helped you, because what they said was, we are not even thinking about reducing rates or stuff like this. So, of course, everyone jumps on the bandwagon. There are a few people in the background saying, ooh, valuations, but don't care. This is the Wile E. Coyote situation. You know, he's running on solid ground right up until 2022, and then the rug gets pulled.
Yep.
And the rug that got pulled, suddenly Wile E. Coyote is off the cliff, his legs are sort of moving, he looks below, and suddenly that's when valuations matter. When liquidity dries up, when people are forced to actually sell assets because they can't refinance them, then the whole thing collapses. And, you know, that's the story of kind of 2022 early. But if you actually have a look at what's happened in global liquidity since that time, since the summer, it's gone up. And guess what? The markets have gone up as well.
Yeah, we see
so you can simplify your life by just saying, okay, this is driving markets. This is the thing I need to look at. It's not something that's going to tell me what's going to happen tomorrow morning, but over a long period of time, whilst there is liquidity in the system, the markets are in good shape. So
that's one of the golden rules I learned in, must have been the late 90s, from a guy called Dr. Jens Erhardt. He is one, you know him, he's one of the great fund managers we have in Germany. And I was a young trader then, and I've asked him at a conference, I think it was over a drink, Dr. Erhardt, could you explain to me, if you don't have a clue, pretty much down the lines of this conversation, how you develop ideas, how markets develop, when do you get in? He said, okay, forget everything you've learned at business school about discounted cash flows and valuation methods. And he said, look at the chart of money supply. If there is a glut in money coming in, markets tend to go up from bottom left to the top right. It's the same direction as the money supply. And if you see that, if they're really opening the Pandora's box of printing fresh money into the market, you can go long, because this money will find its way into the markets, and it will firstly go into financial assets before it's everything else. And that actually served me quite well. Financial crisis, looking at the low in 2008, 2009, when the Fed just opened the box and printed money like crazy. What have we seen since then? This enormous flow. And I'm with you down these lines. The question is now, when does this flood of money becomes a problem? Inflation, you already raised the topic. When is inflation actually getting too strong that people will start realizing if they don't do anything against inflation, against money supply, or if they don't reduce the money supply, inflation will become a real problem. People will then mistrust assets before, and that's the other bizarre thing, start buying them again. If inflation comes too high, we've seen it in the Weimar Republic. If you were an equity investor, you hadn't lost any money. If in Venezuela, you would have invested in the equity market, you wouldn't have lost any money, because inflation suddenly became this beast. Of course, we're talking about hyperinflation here, but the definition of hyperinflation is 30% a month in inflation. We are far away from that. We are talking about meager 5, 6%, 7%, even in official numbers on an annual basis. Where are we in this cycle at the moment, Nick? What do you think?
Well, okay, there's a lot in what you said there. So, you know, let's try and go back a little bit. So in 2020-21, when the central banks flooded the world with broad money, so that's where these money supply numbers actually increased very sharply. And you know what actually happened as a consequence of that, we saw inflation. But the central banks do not look, the Western central banks anyway, do not look at these money supply numbers. They don't care. For them, they think that the world is being steered by interest rates. So they open their drawer, they get out this little toolkit, and the toolkit has got a dial, and it's the interest rates up or down. And that's what they do. And they think that they can steer the world with, you know, demand up, demand down, and that's their little dial. And so what's happening in the background on money supply is going up or down. And up until sort of, you know, for a long time, money supply was growing 5-6% a year, let's just say, for the sake of argument, in Western economies, which is pretty much what you need for 2% growth, 2% inflation, and a little bit into the financial market. So, and that was quite steady. But this number grew to, you know, 30+% over 2 years. And the only way you reduce inflation in that environment is why I you know, when I was asked, you know, by my clients, well, now we've got inflation, you know, what's going to happen? Inflation is going to come down. Inflation is going to come down because this money is already in the system. All right, you can't take it out, and you can only grab the money from people or tax people or reduce the money in some way, shape, or form, but has nothing to do with, in reality, interest rates. Interest rates are not really the tool. What will actually happen is every year you get growth, you get inflation, and that will use up this, if you like, the amount of money that's being created.
Yeah.
That goes down automatically. So if you ask me my view on inflation, my view on inflation is very simple. It's coming down. So you're going to see, you probably won't see 2% for a while, but you will see inflation coming down to, let's just say, 3 to 4% range. Then it will be stable. And why is it going to be higher now than before? Well, it's going to be a little bit higher than before. Firstly, because there's still a lot of money in the system, and it's coming from Asia as well. So Asia is responsible for increased money supply, and they really need it as well. So there may well be a little bit of a global inflation coming, but in reality, this whole inflation topic is, you're going to create a requirement. Well, let's put it this way. What are the key things that are going on right now? Energy, independent energy, reshoring, all of this stuff. And so you're taking away sort of production in a, let's just say, in a cheaper labor area, and you're trying to put it in your own sort of zone. And in doing so, you're going to have to pay a little bit more for stuff, right? So let's be realistic. There will be an increase in the cost of things as we take production from cheap labor into more expensive labor.
So let me ask you if I get that right. So inflation will be eaten up by productivity in the market eventually. The more companies produce, get more efficient, inflation will come down necessarily if they don't print it like
with or without the Fed.
Yeah. However, and that's where you smiled at them earlier, the doomsday Twitter crowd. I'm not on Twitter, but I'm more of, at least on a tactical basis, more on the doomsday side scenario, where I say, okay, what is the toolbox of the Fed? The Fed can't produce shit. So they don't have this quiver. They don't have this arrow in their quiver to reduce inflation. What can they do? They can crash an economy. And the one tool they have available is obviously the money supply, either by interest rates or by stopping printing money or even canceling out bonds they have in there. So at the moment, I see a market here where we still have high interest rates. And for me as an investor or as a speculator, there's always the question, all right, can I buy let's say the spider and have a dividend yield of roughly over 2%? Or do I plunge my money into short-term treasuries and go away with 4.5, or 5%? That is the choice I have at the moment, and I have it risk-free. What's the impact on this situation on the market when we now go a time frame from longer growth? I'm with you on that. But till the end of the year, what is going to happen if interest rates stay high as they are here at the moment? Inflation comes down, but doesn't come down to the magic, I don't know what's even 2%, why they figured that out, but let's say to the 2% level. And we have now corporate earnings coming out. Yes, they were quite convincing so far. But Apple, the 600-pound gorilla in the room, reported last week very good earnings, but revenues went down by 10%. Obviously, the market is saying, yes, they're shifting into services. Services have higher profit margins, and I see that. Yeah, absolutely fine. Nevertheless, left, right, and center, people get fired, especially in the high-paying jobs. We have something which everybody is very, very keen on saying, no, we don't have a financial crisis. Anyway, you switch on the television and you hear somebody's been dragged out and shot in the back of the head again. And JP Morgan gets a lot of extra money and guaranteed risk reward. And that's where I make now my point. And then I want your feedback about that. Short selling. We're both older. I was a partner at Bear Stearns at the time, and I saw my equity being destroyed in the 2008 move to the downside. And I've looked that up earlier. On the 19th of September, 2008, there was a short selling ban for financial instruments called out. So nobody was allowed to sell financials anymore on the short side of the business. And that's very interesting because I'm trying to share my screen now. I did one but earlier so everybody can see that. The yellow line is when the short selling ban was introduced. So the market drifted into the financial crisis and lost about 20%. The officials announced a short selling ban. Well, and then we've seen the low roughly 50% lower of what we have seen before. And what I always thought, now obviously I'm in the business where I occasionally put on a short as well. And I trust people who tell me about these shorts. How do I sell shorts as an institution? I don't sell it when the market is in a dive down. I have the positions and I try to sell them. I call my broker and tell them, okay, if we see a nice recovery or something on the upside, sell into a strong market. Why do I do that? I've done my research. The risk reward ratio is if you buy stock, it can only lose 100%. If you're short a stock, you can lose multiples of that if you get it wrong. We've seen it with all the meme stocks, Bed Bath and Beyond, they're bankrupt now. However, you were right with the analysis, but the market proved you that you could still get screwed. So I do my homework. I put my shorts on, not when everybody in the retail community is screaming, oh, we're going to zero, going to zero. If they forbid me to do that, what they've done on the 19th of September 2008, and the market took a tailspin, I'm not there to buy this stuff back. And now the White House came out last week and said we should really consider a short selling ban. Are we just repeating the playbook? Do I then have a market where risk is being perceived as greater than it might be, even if liquidity is still entering the market? Price earnings ratios will contract in a downturn. And when we have an Apple PE with a forward ratio of something 28, 29, whatever, I remember when Apple was trading at a PE, it's also one of the videos I have here on this channel, with a PE of 9, like a steel mill going out of business before, when the stock was trading at then, I don't know, 55, 56. Nobody wanted to have it. How do I square my Twitter, we are doomed scenario with your more optimistic scenario of, yes, liquidity is coming into the market, productivity will eventually bring inflation down, and then we have a reflation scenario again?
Okay, again, you've probably raised about 10 topics, and I probably will remember only about 5. So let's firstly, we have to clarify something, because you brought it up again about broad money. Somebody will quite easily just say, well, hang on a minute, Nick, look at M2 right now. It's negative, first time in 80 years. Why aren't we, 3,200 in the S&P already? Because that's, everyone's target. And I'm excited. Well, because banks are still lending, because there is still liquidity in the system. And liquidity means sort of balance sheet capacity. And if you look at the numbers that come out every week on Fed, St. Louis Fed, you can see, and I looked at it before, we came on air, bank lending is still growing. I mean, we had a little bit of a wobble. There was 300 billion drop after the first sort of bank hit the skids. But since then, it's gradually sort of ticked up again. We're not at all-time highs again. Yeah. There has been still, and there is continuing an expansion of bank lending. And that is to be, compared and contrasted with broad money. Broad money coming down will actually sort of influence inflation, sort of help. That may well cause, some kind of recessionary concerns, but the financial markets are focused on liquidity right now. And I think, what actually happens is financial markets get resolved, confidence comes back in the system, and then effectively that sort of affects the business cycle eventually. So, that's the first thing about sort of the broad money. The next thing you spoke about was Apple, and you said, well, Apple, earnings were okay, revenue down, market went up. Well, okay, here, let me give you a scenario. Earnings okay, revenues down, market collapses. What's the difference? And the difference is the state of the economy. And that's why I say, the state of liquidity in the system, because, it's that Wile E. Coyote thing that I described. At the moment, you're on solid ground. There's liquidity, so valuations matter less. And the moment liquidity, the rug gets pulled and suddenly there's a contraction, people stop lending, China decides to tighten up, their money, they won't do that. Then Wile E. Coyote is going to be off the cliff. He's going to look down, he's going to say, oh my God, I've just bought Apple stock at this PE. What the hell was I thinking? And then it will go back down to 6 until the markets get resolved. And we have to come back to, so, I mean, just very quickly on that chart of, what is it likely that the regulators will do, given they learned their lesson from 2008, I guarantee you, they will almost certainly make the same mistake because, they open their drawer, the Fed have got their drawer and the regulator's got his drawer and he opens his drawer and he says, oh, short selling ban, like that. I've got paper on that, it's been approved everywhere, so I just need to sign off. It's very easy. I don't have to sort of invent something new. If I invent something new, I have to get more people to agree to it. So this is fairly, standard, dust it off, please sign, okay, job done. And so almost certainly they will come up with something like that, most likely. For banks, I don't know how really what they're doing. We're all guessing, right? But again, why are the banks in trouble? And it's sort of the construct of, the Federal Reserve's interest sort of arrangements between banks and its sort of reverse repo arrangements that creates this sort of anomaly. And of course, by trying to fix something that happened in the past, when money market funds went below par, they broke the buck, as it was called, they had to do something. So they created this sort of world, and now the consequences are, well, if I'm being offered 5% over here and I'm getting nothing from my bank here, what am I going to do? So there's that, right? What else did you mention that is that's worth? So you then said, so Nic, how do I? And I have a view. It's wrong. How do I? And that part of the conversation is all about investment process. And there are, professional people who manage serious money have an investment process. Some investment processes are better than others, right? So, we've seen, I did everything that I would normally do, but I still lost money. And whatever your process is, it has to sort of be kind of bulletproof. And there are times when you have to say, when my process doesn't work, then what's my go-to point? Yeah. I mean, apart from, I cut my losses, or I just sort of get out. Some people can't get out, but they might have to hedge. And that is where, when I talk about macro, and what I see from some sort of less mature macro people, there's some outstanding people out there, don't get me wrong, but for everybody who's sort of trying macro, who thinks that they can understand the world and say, oh, therefore the Fed will continue to raise rates, and therefore I need to do this, and therefore I need to do that, and here's my playbook, sort of we're in deflation, we need to buy gold, we buy treasuries, we need to, buy the dollar. Oh yeah, I know that playbook. But if you do that, and not all of those pieces work, how do you know that it's not working? Do you just say, oh, it will work? And that's the point. And that's where you have to marry macro sort of thinking together with some kind of tool. And I sort of marry my macro view with technical analysis, because it's the technical analysis that will basically say, yeah, that bit and that bit will probably work in this environment, but that bit, and that bit, we're going to leave away, because at the moment, what I can see here, it's not working. And something has to trump something else. And for me, technicals trump macro, because you can always interpret the market wrongly, but the numbers always speak for themselves. And so you want to see supporting evidence that something has to get you out the skids when you think it's not working.
Maybe just a little remark for our youngsters who are viewing us. When Nic and I talk about technical analysis, we're not talking about head, shoulder, or cup and handle. What we are talking about, volume in the market, volatility in the market, where are liquidity pools, where are people forced to do certain things they don't want to do. I was a market maker for options. You've heard about I started writing about that 2 years ago. What's a gamma squeeze? Yeah? When market makers have to do things, I always hear this, I don't have to do anything. If you're a market maker, you have to do things, because if you don't do these things, you start losing money. Identifying these pieces in the markets, and that's why I've called this channel the Tactical Brief. Strategic view is what Nic is telling you about. Where are we? What's the big macro pointers I have in here? I'm focusing more on the shorter term side of the market, because there are certain things I have to do within these markets. And that's how I'm trying to identify the points where I am. And you've seen already, Nic is more positive than the Twitter crowd and I at the moment about the market. I would love to buy markets. I like bull markets. Bull markets are good for business. And well, I have to wait before the market shows me that I can buy it again. And that was one of the points we discussed, well, last week about volatility. The last point I wanted to ask you about this conclusion, because what we've seen is realized volatility. Realized means what the market actually really did. And then there's implied volatility, what everybody thinks what the market is going to do in the future. Implied volatility was elevated and realized volatility came dramatically down. This means portfolio managers, this is a technical again, suddenly had more risk available, more liquidity to allocate in the market. And that is an explanation why markets have seen this relative stability we've seen here, with all the minus points I had in there. But even if we're talking about a positive scenario on the technical side, I have never seen a beginning new bull market with volatilities at 15 or something like that. It simply doesn't happen. You want to load up on equities, especially equities, the moment volatility hits north of 30, when the market is panicking. Now we are in this situation that we had the VIX trading last week at 15, the cash VIX. Amazing. We're up to 20 again, or something around 20. How do you square this pack into the scenario you just described, Nic?
Well, I don't need to buy a market just because there's a 40 VIX, right? So, I mean, this is for sure. In fact, when there's a 40 VIX, I guarantee you 90% of people say, I'm not touching that.
Yeah,
right?
Exactly. That's when you buy it.
But the, how should we say, very good macro funds, what they do is they look for anti-cyclical trades. So as part of their investment process, and they say, we do this, we do this, we do this. Plus we've got an anti-cyclical pot that we try to manage. And when we get, PE levels very high, we offload and we sort of play it more from the short books. When we see VIX really low, well, we start to put on some tactical or strategic shorts in our book. But it's never one strategy, because the point is, if you were this sort of one type of trade approach, you would still be short since October 2022. Yeah. And your investors will already run a mile, probably. So you've got to think about, okay, I think there is some high valuations or some very low VIX. I think part of my investment positioning, if you like, will be, I'm going to be running a 15% short position, but I've got these relative value trades, I've got this other value trade here, I've got this, and you start to build a portfolio. So it's neither all or none, but it's, potentially opening the door to another opportunity for you in managing your sort of portfolio of risk positions. And you talk about sort of, markets going down and stuff like this. And what's my, okay, long-term view, I still think, we're likely to see a new high in US stock markets. It doesn't mean, and, this is part of the granular approach of technical analysis, where I work from monthly charts to weekly charts, to daily charts, to hourly charts, to 20-minute charts sometimes, where I try to sort of boil down and say, well, actually, we could, if we see 150-point sell-off in the S&P, that would make sense in this kind of current juncture, but I'm not looking necessarily for a crash. On the other side of the coin, you also look for points in the market where you'd say, am I seeing things that confirm my view? And currently we are still, for example, in the S&P below this sort of 4195. It was really important on the way down. It's really important on the way up. Actually, on the way down, I think it was something like 4157. I said to our investors, we have an investment thing. If it breaks 4157, down 10%. Actually fell about 15%, I think, after that. And same thing on the way up. I think 4195 is that equivalent point where it will give you confirmation of a bigger move. It doesn't mean you go and buy 4196 or 4197. It just means that you need to start to thinking about, if you're running a short book for these tactical, maybe you need to sort of rethink that and say, okay, I think we're going to have low vol for a while, because they will keep the environment calm. And this is really comes down to the very, very first thing I began the conversation with about where we are in the macro. We are in a very highly indebted world. And that very highly indebted world is a sovereign debt. And if you go back in September and you see what the Chancellor, they blame the Chancellor, obviously, I mean, on what happened to the UK gilt market. What was the first reaction of the Bank of England? So the first reaction of the Bank of England is QE. Even the week before, they were saying, we ain't going to do QE, we're going to do more QT. And then a week later, they said, we'll do QE. And why? Because it's ultra critical, and you talked about hyperinflation, it's ultra critical to maintain the credibility of your bond market. But one thing you cannot accept is if the market is suddenly getting hit left and right and center, that you're not going to come in and protect it. And you're seeing already the first cracks of, you've turned this dial, and suddenly the system that you created, the processes that you created with your banks actually is very, very sensitive, and you can't really go all in and turn that dial. So you might have to dial back that thing or start talking, we're going to pause for a moment. And then ultimately you might have to do what the market's telling you right now, which is, go cut rates. And, that's one of the things that, answers one of the 10 points I've now remembered what you asked me. You said, do I buy 5% treasuries or 2% yielding equities? Well, you probably buy a bit of both, actually. And, one thing I've been sort of promoting for a while now is the sort of 2024 euro dollars were just ridiculously implying very, very high interest rates for another year. Forget that. If you look at the sovereign debt and you go to the Congressional Budget Office, and I did a paper, a presentation last year on this, and I did another one in early March when they revised their numbers. Those numbers get revised even higher, and the interest cost gets even higher. And what you actually see, and it is frightening, if anyone wants to sort of be frightened, don't read Twitter. That's kid stuff compared to what the debt is likely to be in the United States, for the next X number of years. They do their thing till 2033, but there is a forecast on there till 2050 onwards. And it just goes like that. And if it goes like that, well, do you honestly believe that with all of these congressional hearings, that there's not going to be a question, explain to me why we are asking ourselves the question whether we should increase defense spending or whether we should be paying interest on our treasuries. Who's in charge out there? This thing becomes a very political story, and even more political. You see much more involvement from politicians right now in the economy. They will not get voted in on a recession. Next year is presidential year.
I was about to say, let me ask you these questions. Yellen came out and told the market from the 1st of June, US might be declaring bankruptcy if the debt ceiling is not lifted. Obviously, we all assume that's not going to happen. It's never going to happen. People assumed the First World War was never going to happen because it was just stupid. Is there a sleepwalking chance that things blow up? If you would have to put a percentage tag on it, could there be a nightmare scenario where actually the Fed, the Treasury says, sorry, can't pay the bills?
So let me give you an even worse scenario, because the only way sometimes to explain a view is to be even more extreme. And it's a horrible thought, but let's just say there are two superpowers, and both superpowers have nuclear weapons, and both know game theory, mutually assured destruction. Neither of them are going to push the button.
Yep.
Okay, let's now sort of go back to the question you asked me.
Yep.
So the Democrats and the Republicans have this mutually assured destruction game theory thing to play. So let's see what they do. Because if they're stupid enough to not increase the debt ceiling, then, at the back of my mind, I'm going to think, then these guys are stupid enough to push a button.
Yep.
And that will be, the kind of thought process that you must have in your mind as a congressperson or as a president, when you say, well, right, we're not going to pay our interest, because, already the decision to freeze the Russian central bank assets was, how should we say, short-sighted for the US, in my view, or for the Europeans, vis-a-vis the rest of the world, and how they sort of store their reserves, and why they are going to do less in treasuries and more in other stuff. So you've already had that kind of awkward decision. And then you're going to say, you know what, I got more where that came from. I got another stupid decision. You ain't going to get any coupon from me. Sorry. Because then you're back to the point you made earlier about hyperinflation, 30% and so on. Hyperinflation is only caused by lack of confidence. And if you're stupid enough to basically let go and do something that really, in my view, the unthinkable, then hyperinflation, you might as well think about that one as well on your list.
So the question is, we all attach a very, very low probability to this going to happen. The MOVE index, which is an index measuring the volatility index, all my students know VIX, obviously, and they've heard about the MOVE, but just to sum it up, the MOVE index gives the perceived future volatility of the bond market at the moment. And the bond market, because, well, you guys are 3 times as big as we are on the equity side, is usually right. Yeah, bond traders seem to be more clever than equity boys. The VIX, at the end of the day, always does what the bond market is doing. So that's creeping up again. Are they pricing in tail hedges for this eventuality that there could be an absolute, moron blow up on the 1st of June or shortly thereafter?
Well, this is interesting, because last year I started to track for one of my clients the CDS, sovereign CDS. So there was some stuff going on in Japan, and we were looking for some cheap hedges, as it were, in the market. And then sort of Japan went up and it came back down. So okay, that's not the one. But the only and every one that we looked at, so we looked at the gilt, and then that went up and then that came down. Okay, it wasn't that one. But the only thing that never came down was the US. So there are a lot of people you can imagine who are thinking about the worst case scenario. But there are lots of things that you would do. You wouldn't buy CDS. You just go and sell your stuff, right? And the net international investment position in the States is such that people would just say, get out of that stuff, get out of that currency, get out, and that's why I say it's kind of unthinkable, because the consequences will not be sort of felt the next day. They will be felt in the months and years to come, about the ability to finance the debt. And this comes back down to that thing about sovereign debt. So the Congressional Budget Office, who produced this sort of chart that went like this, that scares you and stuff. So you'd say, well, it's okay, because I know how it worked in the old days. In the old days, the Chinese would buy the treasuries, or the Japanese would buy the treasuries, and the Americans, the Europeans would buy the goods. And that was fair swap. Yeah. Doesn't happen anymore. It's not, they don't do that. So the central banks who were previously financing all of this debt, for the data points that have happened over the years, and the last one being the refreezing of the Russian assets, they don't do that anymore. So who is going to finance? So these are the questions you buy. Who will finance the US deficit? So there's a good question for you. So we know that, secretly, with all of that debt, you actually need to have negative real rates. And what's negative real rates? Negative real rates means inflation is here, however you measure it. Everybody's inflation is different. Inflation is up here. And the interest rate that you actually sort of pay people is down here. So you have this negative rate. We've had negative rates for actually quite a long time, since the global financial crisis, only sort of started to turn sort of semi-positive recently, when they felt, well, we've got to do something here. We, can't play this game anymore. But going forward, there will be negative real rates. Otherwise, there is no way that they could finance it. And, there is no support from the Asian central banks who are repatriating. Japan is repatriating, that's why you need to be long in the Nikkei. The Chinese are repatriating, or at least not adding to their investments, and people are just moving away. And so if you force domestic investors to go and buy this 5% treasury thing that you were looking at earlier, and you're thinking, oh, that doesn't look so bad at the end of the day. You're right, the very short end, you're probably okay. But, then you say to people, well, who else is going to finance this exponential thing? Well, I can't rely on my sort of partners or the counterparts anymore, so I've got to do it myself. So I go to the insurance companies, I go to the pension fund. I go to the banks, and the banks say, we just tried that, and then we lost a lot of money because you did some stuff.
Yeah.
And so everyone gets frightened about it. But you then introduce some legislation and say you've got to buy it. You've got to have some high quality liquid assets, more and more on your portfolios. The risk in that is that it crowds out the markets, of course. You've got no room to buy your 2% yielding equity, but they can't afford even to do that, because if you look at the close correlation between equity markets and tax receipts, the moment you kill your equity market, you kill your tax receipts. You kill your tax receipts, you increase your deficits. It's a spiral, it never ends, right? So what they've got to do is, and it's actually written in the CBO estimates, go and have a look at it, from 2025, I think it is, they assume that the Fed balance sheet will increase. Actually, it's on a chart. It was produced in February, this thing, right? So they know themselves that the only way to finance is through central bank financing, which is sort of, better not tell anyone, but they've done that already. You debase your currency. And then what does that mean for sort of the long-term thinkers about sort of what else should I buy? Well, you go and buy, things where there is limited supply. Some high quality, potentially some high quality real estate in sort of centers, not San Francisco, centers that are, sort of people are gravitating to. You buy Bitcoin, you buy gold, you buy, silver, you buy this stuff. Go and have a look at the price of gold versus real interest rates. Real interest rates, effectively, as the moment they've shot up recently, gold equivalent should be $1,000. It's not. Why is it not? And it's not because central banks and, how should we say, people who kind of think they figured out, like me, what's going on, is they've said, well, everything's being debased. We know that they are debasing their currency. And whilst they're playing a stupid game of trying to have a positive real yield, actually they need a negative real yield. And whilst they're playing that game, I'm sorry, I'm moving cash into sort of these types of assets, and that is the kind of the bigger picture that matters, and that's the framework that I've been following, if you like, for the last 3 years. Yeah,
it's actually very interesting, because what I'm going to do now is, Nick, I'm putting out a teaser, especially gold and commodities. You just arrived at the end. I would love to talk that a little bit, or discuss that a little bit more in detail next weekend. When we have our call again, to let people participate, because, well, yeah, obviously gold is something everybody's interested in as a trade. What are the real data points we have to filter into these decisions we're making there? Commodities, and even though I've never touched, you did, bloody bastard, I didn't buy Bitcoins or all these other things when they were cheap. But we should discuss that in detail with your view as a chief investment officer, as a manager who's seeing the broader picture next Saturday or next Sunday, and put it out on YouTube on Sunday again, and get a little bit more into detail with that. What I like to close with is always something, I've stolen that from some colleagues of ours who are on YouTube, with an actionable trade, and I'll put my risk disclaimers in the back. What I have done this week, I've started shorting the shit out of NVIDIA for the reasons we have high interest rates, we have a high PE in there. I don't like the fundamentals of the stock. When you look at the tech sector, and that's what I do a lot, again, a technical point, we look at the standard deviations of the returns we've seen. Bank of America, I'll link that in as well when I do the editing, brought a nice chart out. Technicals are at a 2 standard deviation upside event at the moment, which
That's
means
exactly
there's only a 2.5% chance that this continues. And well, I like the odds of that, especially when I have a scenario where I think interest rates are relatively high, PE is overvalued, a lot of short squeezes happened, a lot of market makers, like my former old self, got shorted, had to play the gamma game in there. So I'm looking at that at the moment. I think we should see over the next 3 months if the recession eventually will kick in, which is my scenario, a level of 220 at the first stop. And I hope I will be holden responsible for my prediction or my trade. As I said, I did it with my money, with real money. I put the trade on, and yes, I will get measured against that. How did I do it? A little bit of advertisement with options. I have a limited risk position. My position is not huge. It's in there. I can afford to make mistakes, but I've started building it up. And have a look at it yourself. Have a look at the chart.
I just did.
Fundamentals.
I just did. I had 30 seconds whilst we were talking. Sorry about that. I was listening as well.
What are you going to do?
I just pulled up 2 charts, and this is, if this is your sort of trade of the day, we need to talk.
All right, you heard it here first. Obviously, Nic is buying the over. Yeah, at which level do you buy the over? 3 months from now.
So what over?
On Nvidia. At the moment, they're trading something around 285 or something.
Yeah.
3 months from now.
It's not a short for me. That's all. There's no, I could show you charts where I'd say, now you need to sell this thing. But when I look at this chart, I'd say, show me another one. That's how if you were one of my fund managers and you brought that into my room, I'd say, interesting, you give me a valuation story. It's okay. Go find me another. And, let's because the timing of this thing is so critical.
Yes.
If you want to, if you get the timing wrong, hold it, being able to hold a position, one of our, very sort of good clients, always had the view to say, I need to know that I can hold a position. And which means, for guys with a limited pot, that's a very important thing to do. So I would just say to you, come up with another one. But
brilliant.
Nothing.
Hey guys, that is exactly why I love to shoot these kind of videos, because this is the kind of conversation we have all the time. You put something out there and somebody smart, closing the circle here, tells you you're talking bullshit. The beautiful thing in our market or in our profession is we set up a thesis, we put our money to it, and the thesis gets tested. There is no ambiguity after the time horizon. And you can't say, oh yeah, but I was morally right. Now you've lost money. Or you say, yeah, I was morally right for the wrong reasons and you made money. Nobody gives a shit at the end of the day. Yeah, it's always then, oh, you had the right strategy. No, I was just fucking lucky. So I try to get my ducks in a row, have my probability. One of the things I work a lot with is, as I just mentioned, mean reversion of returns. When I see something with a huge move to the upside or to the downside, I start building up positions. But I like that you would shoot me down in your office. Thank God I'm not in your office, Nic. And next week, if you're bullish on the shit coins again, I'm going to challenge you with the party trick I always have. I have a piece of gold here. This, in this case, is my lighter. And when everybody tells me Bitcoin is great, I said, imagine Bitcoin being the electricity and switch the light off. It's not a real asset. But if you like to hear that conversation, I hope you tune in next week, and we will welcome all our commodities, gold bugs, and crypto boys. And I will shut up a little bit more because I really don't know anything about this stuff, but Nic does. And he has the cars, houses, flats, jets, boats to prove it. Nic, thank you very much. That was awesome. And I hope I see you next week on Sunday again in my little office and talk about all the things we see. Thank you.
Jolly good. See you.
Thank you, guys. I hope you enjoyed that. As it always turns out, I don't like it when I'm wrong, but we'll see whether I'm wrong. I hope you enjoyed it and see you next week. Thanks a lot.